Okay, welcome back everyone to our options education webinar series. Today we're going to be talking about LEAP options. This is a new webinar topic that we've never covered before. I'm quite excited to talk to you guys about this trading LEAP options. This is one of the few webinars that we do that's geared more so for those of you that are stock traders or specifically long-term investors, which is really what LEAP options are for. It's a stock replacement strategy. We'll get a little bit into kind of what that means, what are the mechanics of trading LEAP options. But this is really for those of you that are that look at longer-term stock investors, how to utilize options as a replacement for just buying the outright stock. There are some additional benefits such as limited risk and also allowing you to generate income against LEAP options that can be more efficient than simply just buying the stock. So today we're going to go over about 15-20 minutes using the slides, showing you really comparing buying a LEAP option versus buying a stock, showing you the differences, making sure you understand what are the differences between the two, what are the benefits, what are the limitations to LEAP options, so that you can make a decision as to whether, when you're thinking about buying a stock, whether you should look at buying that stock or look at buying a LEAP option. Also, we'll look at a little bit about how you can use LEAP options also alternatively as a hedge for your portfolio. I think that's a fairly timely conversation to have as markets are making all-time highs. The markets are extremely bullish. These are the types of times that we typically think about or at least start planning for potentially if there was a market correction or the market pulls back. How do we actually how do we play that? How do we protect our portfolio? So now is a good time to consider talking about that. And LEAP options are a great vehicle to potentially do that. So today's format's going to be a little different than usual because I'm actually going to talk about how to, when you should consider using LEAPs first before we actually discuss what LEAPs are. Usually I talk about the strategy first before we talk about when you should utilize them. But I first want to talk about when you should consider using LEAPs because that's really helps set up the conversation for everything else. It's first really important to understand when you should use them because they're really only used for very specific scenarios. So I want to make sure I address that first. Then we'll talk about what LEAPs are, how to construct them. I'll talk a little bit about the optimal LEAP strategy, meaning what type of expirations, what type of strike prices we see are best suited for this type of strategy. I'll talk a little bit about trading tips if you're trading LEAPs, some tips for how to utilize the strategy. And then I'll end this with talking about a strategy called poor man's cover call, something that people have asked me to cover on some of the other webinars that we've done on cover calls. However, I want us to take a little bit more time to address that strategy of a poor man's cover call, meaning going long the LEAP and then selling cover calls against that. And then like we always do, we're going to end this session by going through some real examples of when you should consider using a LEAP for both a long-term bullish strategy on a stock, but also as a potentially as a portfolio hedge. So we'll go over both of those scenarios here today. Now, this webinar is recorded for those of you that are brand new to Options Play. Welcome. The format that we typically have is I spend about 20 minutes using the slides. The slides will be emailed to you afterwards. So if you want to follow along, we will send them to you along with the recording. And especially for those of you that are brand new, the slides will include some important links, such as the previous webinar recording. So I will reference a previous recording that we've done on cover calls. If you want the link to that, it's in the slides. If for those of you that want to follow some of our daily trading ideas, the links to those daily ideas are here as well. And then also follow us on YouTube. And for those of you that want to learn more about options, a great resource is the Options Industry Council. I have a link for that at the bottom of the links in the slides. So for those of you that are following along, make sure you download the slides as well. It's got some important links for you to take a look at with some important resources. And then make sure that you take a look at the recording afterwards so that you can follow along. I am going to go through quite a bit, so I don't expect you to memorize everything. So make sure that you take a look at that recording afterwards. So let's talk about when you should use leaps. Before we talk about what leaps are, I want to make sure everyone understands when we should use them. So leaps are a long-term, or it's a long stock replacement strategy. So you should only consider using leaps if you're considering buying a stock. If you're thinking about buying a stock and you have a bullish outlook, that's relatively long-term. And what I mean by that is anything greater than 2 to 3 months. So think back about the trades that you make with underlying stocks. Stocks that you've purchased and held on to for at least 2 to 3 months, if not longer, maybe even 6 months or a year or 2 years. Those are the types of trades that you should even consider looking at a leap option for. And also, these are for stocks that, you have a bullish outlook long term, but you also see some downside risks. This is especially important for stocks that are perhaps hitting all-time highs. You want to get into these stocks. They're hitting all-time highs. You're concerned about pullbacks. You think there's some downside risks. These are the types of opportunities that you should consider using a call leap option for. Conversely, if you're looking for puts, this is really for those of you that are looking to hedge a stock or a portfolio. This is where you have a bearish outlook on an individual stock or a bearish outlook on the overall market that lasts at least 1 to 2 months. This is where you should also consider taking a look at leaps. So before we define what a leap is, these are the 2 time frames where you should even consider taking a look at leaps. Both when you're bullish long-term on a given stock or perhaps even a specific sector or market, because you can use ETFs for that. And then if you're expecting a market correction either on a specific stock or on your whole portfolio over a 1 to 2 month period, if not longer, that's when you should consider using a leap. So before I move on, I just want to do a quick poll here. How many of you own stocks in your portfolio for longer than 2 to 3 months? Any of you that have owned stocks that you've held on to for at least 2 to 3 months, I just want to get a feel for how many people fall into that category versus how many people are only trading very short-term strategies. Okay, so pretty much this is a very, very predominantly skewed poll here. About 95% of you say that you have some stocks that you own more than 2 to 3 months. Only 5% of you say that you only trade very short-term strategies. So let me just address this. For those of you that say you only trade very short-term strategies and you're never buying a stock, holding on to them for 2 to 3 months, leap options is not a strategy that I would recommend for you to trade these types of short-term strategies with. There are plenty of other strategies that you should utilize short-term strategies with: debit spreads, credit spreads, just an outright long call or a put. Those are better for those very short-term based strategies. For those of you that do trade stocks that you've held on to for at least 2 to 3 months, that's when these are the types of strategies that you should consider taking a leap strategy for. Okay, so just make sure that I want to address that right in the beginning. So what are leap options? Leap options are really simple to understand. If any of you have traded any options, if you've bought any calls or puts, a leap option is simply just a call or a put option where the expiration date is longer than 9 months from today. So basically, they're the exact same thing as a regular call or put. They're just calls and puts that expire a long time from today. And there are 2 strategies for leaps. For bullish strategies, you can go long a call. This is where you will gain upside exposure in the stock or ETF with limited risk. And that's really one of the key elements of trading leap options, is getting that upside exposure, but with limited risk. And the key part here is limited risk, because we want this asymmetrical risk profile that gives us unlimited upside, but limited downside. And that's really why people look at options as a strategy, because it provides them with that asymmetrical risk to reward ratio. Conversely, if you're bearish on a stock or ETF, this is where you would look at a long put. This gives you downside exposure. So if the stock goes lower or the ETF goes lower, you're going to get exposure to that and be able to profit from a move lower. And again, also provide you with limited risk. So the key thing to remember here was what we're comparing here today is long call and long put, but don't think of this as comparison to other option strategies. I want to make sure that we're all thinking about this is only a comparison for buying the stock or shorting the stock. So let's take a look at what the difference is between the two and actually make that comparison so that you can see them side by side. So let's first break down the bullish example. So we're bullish on a stock. Let's say you have a stock in mind. You're long-term. You think the stock's going to appreciate in value. So one thing you can do is you can buy the stock. The other thing we're suggesting that you can take a look at as an alternative to that is buying a leap option. So let's take a look at this. Leap options provide you with what we consider unlimited reward with limited risk. So right now, what I'm going to do is I'm going to use a fictitious stock XYZ. We're going to jump to a real example at the very end. However, for illustrative purposes, I'm going to use stocks XYZ trading at $100. These are nice round numbers for my example. So traditionally, if you're bullish on stock XYZ, you think it's going to appreciate in value in the long run, what can you do? You buy the stock. That's a simple strategy that you can use for stocks in order to do that. So let's say you buy 100 shares of that stock at $100. That basically costs you $10,000. What's your upside if you buy 100 shares of that stock? Your max reward is unlimited because the stock can continue going higher. There's no limit to how far that stock can go. So your max reward here is unlimited. Your max risk here, however, is $100 per share because you paid $100. That stock can theoretically go to zero. So your max risk is $100 a share. Conversely, if let's say we bought a long call or a leap option, and here in an example, I'm saying that we're buying a January 2020, which is about a year and 3 months from today. So anything greater than 9 months is considered a leap option. So I'm looking at one that's a year and 3 months out. Let's say I buy the $85 call, which cost me $25 to buy. So instead of paying $100 to buy 100 shares of the stock, I'm paying $25 to control 100 shares of that stock. And my max reward on this trade also is unlimited because buying a call has unlimited risk, has unlimited reward to the upside. However, as you can see, my max risk is only $25 because I've paid $25 for the call option. My max risk is also going to be $25. So that is where my risk is a quarter of what it would cost to buy the stock. And my cost to get into the trade is only a quarter of what it would cost to get into 100 shares of the stock. So this is the comparison that you should make next time you're thinking about a stock that you're bullish on long-term. Think about buying the stock versus buying a call option or a leap option instead. And the benefit for this is that you get reduced risk because the amount of money you paid is the absolute dollar amount you're willing to risk. It has a lower cost, so you don't need as much capital to get into a trade. Think about some of those high-priced stocks like Amazon, where you need almost $200,000 to buy 100 shares of that. Not everyone has that kind of money laying around in their account. So how can you still take advantage of a round lot? You can buy a leap option. So that's really what we're going to look at here today. And what it does is it maintains your unlimited upside exposure. Unlike other option strategies where you have limited reward, when you're buying a leap, you maintain that unlimited upside exposure. So especially stocks that you really think can take off in the long term, especially stocks that you think perhaps there's some downside risk to it, this allows you to maintain that upside exposure completely unlimited to the upside, but maintaining that unlimited risk so that if the stock does plummet, that you are protected to the downside. Next, let's take a look at a bearish example. Same thing. When we're talking about looking at a bearish leap or a put option, you have unlimited reward with limited risk. Now, technically, a put option does have limited reward because the stock can't go below zero. But for all intents and purposes, it's unlimited reward to the downside because you're able to take advantage all the way for the stock down to zero. So same thing, I'm going to give you the example of stock XYZ trading at $100. If you're bearish on the stock, you would typically short the stock. That would be the only option that you would have if you're trading just stocks. So here I have an example here where we're bearish, we're short the stock. So let's take a look at shorting 100 shares at $100. Your max reward here is $100 because if the stock goes all the way to zero, you're going to realize all of that profit. You've collected $100, you pay zero to buy it back when it goes to zero. So your max reward is 100. However, when you're shorting a stock, your max risk is unlimited. This is really one of the reasons why we generally don't tell users to short stock, especially if you're bearish on a stock, simply because put options give you same downside exposure, but with limited risk. So let's take a look at that long put instead. So let's say we buy that January 2020 115 put that's trading at $25. So now your max reward is also $100. However, your max risk here is $25. So instead of $25 a share, let me just clarify. So when we're talking about max reward is $100, it's $100 a share. Your max risk is $25 per share. So what this does here, this is really a prime example of why you should consider using puts, is that you're capping your risk, because when you're shorting a stock, you have unlimited risk. This is really not a good position to be in, because shorting a stock has huge amounts of risk, and you want to make sure you limit that. And one of the best ways to do that is by buying a put. And you still, again, maintain your unlimited downside exposure. Very important concept, because you want that downside exposure, because especially when you're shorting a stock, stocks can move down fairly quickly. Think about Facebook on earnings moving down very, very quickly. These types of moves to the downside tend to be more violent, and being able to take advantage of that, puts allow you to do that. But if it does not work in your favor, you have limited risk to the downside. So what are some of the benefits to trading leaps? Number one, the key here is to get similar exposure to stock, but with limited risk. When you're buying a stock, when you're shorting a stock, you have substantial amount of risk. So if you buy 100 shares of that stock, it can go down to zero, and that you would lose all your money. Versus if you're buying a call option, you're only putting up a fraction of the amount of money to buy 100 shares of the stock, and your risk is limited to that. So that's really the key benefit of trading leap options versus just outright buying a call or shorting a call. Second of all, the reason that we use leaps instead of other than shorter dated options is really because leaps give you very low time decay. So time decay, or theta, is what's working against you when you're buying an option. When you buy a leap, that theta is very, very low. So that means that you have less time sensitive to owning that call versus just buying a short-term call. And you typically pay very low extrinsic value. That's the time value that we're talking about. When you're buying a leap option, you generally have relatively low extrinsic value, so that this time decay is not working against you as much as if you buy a shorter dated option. That's really the benefit of trading these long dated options. Even if you only intend on being in the trade for 2 to 3 months, you should still look at trading maybe 9 or 1 year options because of this low extrinsic value. Now, there are some limitations to trading these leaps. It's not just all roses. When you're trading leaps, they tend to be less liquid versus the front month options. So you want to make sure that you are aware of that. These are not vehicles for active traders. This is why, again, I said, for those of you that are trading very actively, in theory, leaps would give you that same upside exposure with limited risk. But if you were trading leaps very actively, you'll see that they're not very liquid. So it's not something you want to move in and out of very often. It's something that you want to buy and maybe hang on to for at least 2 to 3 months before you maybe potentially sell that that leap, either at a profit or a loss. Second of all, when you own a leap versus buying a stock, you don't receive the dividends. So if you own a stock, let's say you're bullish on a stock and you buy that stock, you're going to receive dividends as they pay out. If you're long that same leap, you're not going to be paid the dividend. So keep that in mind. So if the dividend is important to you, you might be better off just buying the outright stock. They tend to not be available on all options. Leaps are only available on about 2,500 options. The good thing is that leap options are mostly available on the big names, the most liquid stocks, ETFs, and indices, which is generally speaking the names that you should be trading leaps on. It's the small cap names where you don't have leap options a lot of times, but usually those are the names that you wouldn't necessarily trade a leap on anyway. So, but those are some of the limitations that you generally have when you're trading leap options versus outright buying a stock or shorting that stock. So what is kind of the optimal leap strategy? And this is really, and I'll illustrate this in the next slide, but the optimal leap strategy, number one, like I said, they're available on about 2,500 stocks, ETFs, and options. So about half of available optionable stocks or ETFs you can trade leaps on, which covers, in my opinion, most of the ones that you really need to be trading options on. Like I said, you generally want to trade expirations that are greater than 9 months. That's what we consider a leap to begin with. And again, the reason we do this is because the longer dated options minimize theta, or that time decay. This doesn't mean that you have to be in the trade for longer than 9 months. This just means that you should buy a leap option that's greater than 9 months. So you could be in the trade for only 3 months or 6 months, but you should still want to buy that option that's greater than 9 months, because the theta decay for those 3 to 6 months is going to be much lower than if you bought a 3 or 6 month option. Next, when it comes to selecting strike prices, This is really where it differs, but the rule of thumb here for when you're buying a leap option is you want to buy in the money strikes, and you usually want to target somewhere around a 70 to 80 delta call option or a put option when you're buying these leaps. And I'll give you plenty of examples later to show you why these in the money options will give you better bang for your buck, even though they're more expensive, why they're better for this specific strategy. And for those of you that may not know what 70 to 80 delta is, you don't necessarily need to use that as a benchmark. For those of you that do, that's great. But one of the easier ways to figure out what is the right strike price on a leap is to find the strike price where the cost is about 20 to 30% of the underlying stock price. So if you have a stock that's trading at $100, you want to find a call option that's trading about $20 to $30. That will get you in the right range of the in the money 70, 80 delta call options. So even if you're not looking at delta, just by cost alone, you should pretty much be able to eyeball what is the right strike to buy. 20 to 30% of the underlying stock price is usually a good starting point if you're buying a leap option. So let's take a look at why we tell you to buy in the money leap options. So what I have here is 3 comparisons. How each strategy performs. First, in the first column, I have buying the stock, buying 100 shares of the stock. This is the same example that we had before. What I have here is buying a in the money call option, so an 85 strike call option, an in the money call. Let's say I paid $20 for that call, versus buying an out of the money leap option, let's say a 110 call, and that only cost me $5. So a lot of people will say, why would you buy a leap option that costs so much when you have the ability to buy a leap option that costs a quarter of that? And the reason for this is really because, and here's kind of, I've broken down here. This is a stock trading at $100. What happened if the stock goes down? What happened if the stock goes up? How each strategy performs. As you can see here, if the stock goes down to $50, here I lose $50 if I bought the stock. I lose $25 if I bought the call option. I lose $5 if I bought this leap option. So here in this example, it sounds like the out of the money leap option is the winner here because I lose the least amount of money. However, as you can see, as I go through all the other examples, the leap option starts to underperform. If the stock goes down a little bit to $85, if I had bought the 100 shares, I'd lose $15. If I bought the leap option, I'd lose $20, or in the money leap, I'd lose $20. If I bought the out of the money, I still lose $5. Next, if the stock stays exactly where it is at expiration a year from now, if I bought the stock, I basically lose nothing because the stock is where it is. Here, both the in the money and out of the money will lose $5, so those two are the same. But as you can see, if the stock goes higher, and the reason that I buy these leap options is because I think the stock's going to go higher. Here, I have a $20 gain if I bought the stock, a $15 gain if I bought the in the monies, and then a break even if I had bought the out of the monies. So even if the stock rallies 20% in a year, I'm still just breaking even on that out of the money call option. And all the other scenarios where the stock stays where it is and moves lower, I'm losing $5. And only when the stock makes a big gain, let's say a 50% gain over the next year, does the stock give me a 50% return versus a 45% return on the leap option, a $45 gain, and then only a $35 gain on the out of the monies. So unless you're expecting a very large move, this out of the money leap option, generally speaking, for 4 out of the 5 scenarios will basically net you either a loss or just a break even, versus here, the in the money call option gives you similar upside return as the stock. So as you can see, very similar upside return as the stock. But if there's a catastrophic loss on the trade and the stock goes lower, you have limited your loss on the trade. So here, actually, I'm sorry, this is a typo here. There's only a $20 loss here as opposed to $25 on the in the money call option if the stock goes down to $50. So this is really why we want to compare buying an in the money call option versus buying a stock option. So some trading tips on leaps before we jump into some real examples. And I want to show you some real examples because that's really going to help solidify, allowing you to compare buying the stock to buying a leap option. I want to talk about some of the trading tips. So number one, when you're trading leaps, you shouldn't really think of them as trading options. You should really think of them as almost like just a replacement for the stock. So you enter and exit these trades as if you're trading the stock. So when you're trading a stock, you want to go You want the stock to go higher. You should have some target prices as to where you think the stock's going to go. You should also have some stop losses on the stock if the stock goes lower. So you should maintain those target prices and stop loss prices on the stock and enter your leaps as if you were trading the stock. That's first and foremost. When we're trading these leap options, you should really think of them as very similar to trading the stock. So enter and exit as if you were trading the stock. And these are generally better for non-dividend paying stocks because, again, when you're buying these leap options, you're not going to get that dividend. So you're losing out on quite a bit of yield. However, in exchange for that, one way that you can make up on some of those dividend paying stocks for leaps is to sell a poor man's covered call. We'll cover that in the next slide as to what those mean, what that means, what the mechanics of that is, and also how much yield you can actually generate from a poor man's covered call. But like I said, to enter these leaps, you want to enter with a long-term bullish or bearish outlook on either a stock or ETF or index. Very straightforward. Whenever you feel that you're ready to buy a stock or short a stock, that's a time you should consider taking a look at entering a leap. And as far as an exit strategy your exit strategy always should be exit before expiration. These are typically not the type of trades that you hang on to all the way to expiration. Like I said, you would typically buy a 9-month or 1 year or even 2-year option, but you typically hold on to these trades only till you're bullish, only until you're no longer bullish on the stock or no longer bearish on the stock. You usually want to exit these trades prior to expiration. You want to set stop losses and take profits, again, based on the stock price, not based on the option price, because you should really, again, think of these as a proxy for the stock, not necessarily as an options trade. And these are really only for those of you, again, for those of you that have longer term bullish or bearish outlooks on an individual stock, sector, or specific market that you can trade an ETF with. So lastly, what I want to cover is once you're long a leap, either a call or a put, you can sell what's called a poor man's cover call. This is really the exact same mechanics as a cover call. However, the goal here is to sell 1 month or short dated calls and puts against the leap that you own. And the reason you want to do that is because for the same reason you sell cover calls. You want to generate income and you want to reduce the cost basis of the long stock. And in this case, instead of long stock, you're just replacing that with a long call. It's the same methodology as cover calls, meaning the same way you find your cover calls expirations and strike prices, you apply the exact same methodology to selling covered leaps. And again, the overall goal here is to reduce the cost basis of the leap that you own. So when you're selling cover calls on stocks that you own, you generally will be able to find that you're going to be able to yield somewhere between 3 to 10% per year in reduction of the underlying cost basis of your underlying stock. Versus when you're buying a leap, they cost only about 20 to 30% of the underlying. You're usually able to generate anywhere from 20 to 50% reduction in your cost basis by selling a leap. So for those of you that own 2-year leaps, if you're selling 1 month calls against it, sometimes you're able to even reduce your cost basis down to effectively zero if you're able to do this over and over again throughout the year. So covered leaps really provide you with quite a bit of income with respect to the cost to buy a leap and still giving you that same upside exposure. The only difference between trading covered calls and covered leaps is that especially if you're in the earlier days of your leap, so if you just bought a 1-year leap and you're only 1 month into it, generally speaking, you want to roll those short calls instead of having them assigned to you, because in order for you to have a covered leap assigned, then you have to exercise the long leap, the leap that you have, which means that you lose the extrinsic value of the leap. Granted, that extrinsic value is relatively small, but it's still free money that you're giving up by exercising your long call in order to pay for the assignment. So when you're selling a covered leap and you're in the early days of your leap, you generally, if the stock price ends up above your strike price, you usually want to roll meaning buy back your short call and sell another short call instead of allowing that assignment to go through. So that's really just some tidbits on trading a poor man's cover call. So with that, let's take a look at some live examples of leaps. What I have here is options play. For those of you that are brand new to options play, welcome. I hope you have the ability to sign up for a free trial and check this out. This is the platform itself. It's divided into 3 sections. We have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. Trade ideas and watch list provide you with what symbols you should take a look at every day, either fresh trade ideas that we scan for technically, or watch lists that you've built, or the pre-built ones that we have to give you an idea as far as what symbols to look at. Our security analysis panel is designed to give you snapshot data of what's currently going on with the stock, both the trend analysis and relative strength analysis, so you can very quickly gauge a directional view on each individual stock or ETF. We have a specific webinar just on that alone. So especially for those of you that are brand new, I highly recommend you to take a look at that webinar to learn of how to utilize our trend and relative strength indicators to gain a bullish or bearish view on any underlying stock. And then all relevant information such as earnings, dividends, and price action data here at the bottom of your screen. So once you've gained a directional view, and I'm pulling up Amazon here because I think it's a pretty interesting name to look at, because very few people have the amount of capital to buy 100 shares of Amazon. So here I'm going to click on I'm bullish, and we're going to be presented with 3 bullish strategies on how to take advantage of a short-term move on Amazon. So you can buy the stock, you can buy a call, or you can buy a call spread. Today, we're going to modify these 2 strategies here on the right to look at leap options. So here, what I'm going to do is I'm going to modify this leap and change it from the November 2nd to the January 2020s. And like I said, what I'm targeting is roughly something that costs roughly 20% of the underlying. So the underlying cost me $194,000. So I'm going to target something that a strike price that costs roughly about $40,000 or so. So here, if I look at my strike drop down, so the $40,000 range would be about the $1,800 call. So the Amazon's trading at 1944. 1,800 call costs $40,000. As you can see, that's 1/5 the price of buying 100 shares of the stock. So you can gain very similar upside exposure to 100 shares of Amazon for 1/5 of the price. And then what I'm going to modify here on the right-hand side is I'm going to take a look at another leap option. I think there was actually a question here about looking at the money leap. So let's take a look at an at the money leap instead. So we have buying the stock, buying an in the money leap, and buying an out of the money leap. And what we're going to do is we're going to use our P&L simulator and actually see how these 3 strategies perform in different scenarios and show you why this strategy, the in the money leap option, is, in my opinion, the better leap option to go with, because it really allows you to take advantage of that bullish view. Even if the stock doesn't go as much in your direction, you're still protected. And that's really the key point. The reason that you generally don't want to trade out of the money or at the money call options is that if the stock stays where it is, you lose all of that money. That's a lot of money to risk. So even though $40,000 is a quarter of the price of buying 100 shares, that's still a lot of money at risk. So we want to make sure that we do everything we can to try to minimize that risk. So let's take a look at these 3 strategies. So as you can see, the stock's trading at 1944. So first, I'm going to take a look at what happens if the stock stays exactly where it is upon expiration next year. So here, if I had bought the stock, I'd lose $0. If I bought this in the money call option, I lose $25,000. So quite a bit of money that I'm losing here if the stock stays where it is. But if I bought this at the money call option, I lose $31,000. So even though this strategy, the in the money call option, costs more than the at the money call option, if the stock stays where it is, I actually lose less money, even though this costs more. And that's really one of the benefits of trading an in the money call option, is that even if the stock doesn't move quite as much in my expected direction, I'm still actually risking less than a strategy that costs less to begin with. So we usually think of call options that cost less as less risk. But here in this particular case, as you can see right off the bat, if the stock stays where it is, the more expensive call option actually has less risk. And that's, again, one of the reasons why we always encourage, if you're using leap options, to consider taking a look at the in the money call option versus the at the money or out of the money call option. Now, let's take a look at what happens if the stock goes higher. Now, Amazon's trading at 1944. If you're owning this stock long term, I would expect that you would think that the stock's going to go at least above the price that it was at just a few weeks ago, 2050. So let's say you think the stock's going to go to 2100 or 2150. Let's take a look at how these strategies perform. So if you had bought the call, if you had bought the stock, you make a 20% return. A 10% return, a $20 $20,000 profit. If you bought this leap option, you make a $5,000 loss actually. So again, this is only for those of you that have a long-term, fairly bullish view on this particular stock. As you can see, a 10% move still doesn't even overcome the cost of this call option. So in my opinion, this is a fairly expensive call option. Not necessarily great if you're just mildly bullish on an individual stock. This really requires a fairly large move in the underlying stock. So the stock, let's say the stock moves 25% higher to, let's say, roughly 2,400 or so. This is where if you had bought the stock, you make a $4,800 profit. If you bought the call option, you make a $23,000 profit. If you bought the at the money, you only make a $15,000 profit. And here we can use dollar amounts to compare because that's a fair comparison of buying 100 shares versus one call option versus one call option. So this is really allowing you to compare apples to apples, 100 shares, how these would perform. So as you can see, the stock really needs to take off substantially before this at the money call option is similar to buying an in the money call option. And this requires the stock to move all the way up to 2,800 before these two strategies really look somewhat similar. Now, they're never going to perform as much as well as buying 100 shares. However, the benefit to this is the downside risk. So what happens if Amazon really takes a dive? What happens if it goes down to $1,500? Here, as you can see, if it went down to $1,500, this you would lose 44,000. Here you only lose 40,000. Here you only lose 31,000. So here, and actually in my opinion, the leap option isn't super attractive, and that's partially why you have such a low options play score. This is telling you that $40,000 is quite expensive for an $1,800 call. So this is an example of where you can use this tool to compare whether you should buy a call option or, a leap option or buying the stock. And in my opinion here, the leap option isn't actually super attractive. So maybe let's take a look at a different stock. Let's look at Apple instead. And I'm not necessarily sure that Apple will give you a better picture per se, but let's look at Apple. Apple cost $22,000 to buy 100 shares. Let's say we look at a leap option here again, the January 2020s. So $22,000, about 20% of that is roughly $4,000 or so. So let's say I choose either a 200 or 195 call option here, roughly about 1/5 the value of 22,000 versus 4,300. And then same thing, let's look at a long call here, same thing, January 2020, and we're going to also look at a at the money call instead. So here's another comparison. We're buying 100 shares, which costs 22,000. We're going to buy a leap option, which costs 4,300, or we can buy an at the money leap option, which costs 2,800. So first, again, I want to start off by comparing what happens if the stock stays exactly where it is. So again, even though this option costs more money than this one by almost double, you actually lose less money on the in the money call option if the stock stays where it is at 220 next year. The stock, if you bought the stock, you make zero return. If you bought the call option or the in the money call option, you lose only 1,700. If you bought the out of the money, you lose 2,800. So again, this is why we generally don't like trading at the money leap options, because the stock, even if the stock does slightly better, so as you can see, Apple's trading at 220. Maybe I think it's going to go to 250 by next year. Here, if I bought the stock, I make a $2,900 return. Here, I make a $1,200 return, which is a 27% return versus a 2,900, and this I make only $175 profit. So we also have to keep in mind that even though the dollar amounts are significantly less than buying the stock, but because I've paid substantially less to buy this leap option, my returns are going to be much better, much quicker. So as you can see, even the stock goes to 243, the return on the leap is better than the return on the stock. And if the stock goes to 243, if I bought the at the money leap options, I'm actually still going to have a loss on this trade. It really requires a substantial move before that out of the money leap option. As you can see, the stock needs to move to 270 before the at the money leap option outperforms the in the money leap option. So again, this is why we generally tell users to take a look at these in the money options as opposed to just buying the outright stock or the at the monies. Now, the reason that you generally want to take a look at these types of strategies is because, if there's any downside movement in these stocks, and this is really for if you're expecting potentially a large move to the downside, you are protected in terms of the amount of money that you risk, because you have an absolute dollar risk of 4,300 and 2,800 if the stock really does plummet between now and January 2020. And one of the things that we want to show you is that, as you can see here, buying 100 shares of stock costs you $22,000. Buying this leap option costs you $4,300. So let's take a look at a poor man's cover call. Let's say you decided to buy this January 195 call. And the other thing also, sorry, before I move on, the other thing to consider is you can also, like I said, you don't necessarily have to say that I expect this move to happen between now and expiration. Maybe you expect a move to happen by the end of next quarter. Maybe you think that Q1 earnings after the holidays are going to be good and you expect the stock to maybe go up to 250 by then. So as you can see here, if you expect a quick move higher, you can then look at what the returns are for each one. And that return profile may look very different than if you expect to hold this to expiration. Like I said, usually when we're buying leap options, we're generally not holding them to expiration. So depending on what your views are on where you think the stock might be between now and maybe 3 months from now or 6 months from now, you can use our P&L simulator and see exactly how each strategy performs. So if you think that maybe over a 1 year time span, till the, let's say, September 20th, 2019, you think the stock's going to go up to 250. Here, if you had bought the stock, you make a 13% return. If you bought this leap option, you make a 30% return. If you bought the at the money, you make only a 20% return. So this really allows you to compare different strategies, different time frames, and see exactly how these strategies perform. Really important. And since this only costs $4,300 versus $22,000, if you were to sell cover calls against this, as you can see here, I can gather about $127 in premium every 22 days. So that means over a 1 year time span, I can bring in roughly about $1,500 in premium. That's almost a third of the cost of buying an that in the money leap option. So I can reduce the cost of my leap option from $4,300 down to about $3,000 by buying, by selling cover calls against it. So that's really one of the benefits of a poor man's cover call, because you can significantly reduce your cost basis of the long position that you have by buying a leap option compared to just buying an outright stock. So lastly, what I want to do is I just want to do a put strategy to show you, for those of you that maybe consider using this as a hedge for your portfolio. And again, I've actually done a specific webinar just on hedging. So if for those of you that are interested in learning more about hedges, certainly please take a look at that webinar. But today what I'm going to do is I'm going to show you using SPY as a proxy for hedging a portfolio. So first off, let's modify. Let's say SPY just hit brand new highs. You're concerned about a correction. I'm not necessarily suggesting that you should enter a put hedge by any means right now, especially at all-time highs. But if the market does start to correct and you're concerned about a bigger correction that's about to happen, maybe because interest rates are about to rise, you're concerned about that. Let's take a look at hedging portfolio. So let's say we're buying a put here. I'm going to January 2020 put it again. Let's look at an in the money put. So roughly, $5,000 is roughly a fifth of the $30,000 underlying shares, versus if I bought a out of the money or at the money put. Let's say I buy an at the money put instead. Let's compare all of those next to each other. So what I'm going to do is let's say I have a $100,000 portfolio, just to make everything even. Let's say I have a $100,000 portfolio and the market stays exactly where it is 1 year from now, or January is flat. However, I lose options because, as you can see, even this, I'm only losing $480, cost only a third of this. It is, or if the market stays flat. Here on the portfolio, because I have a $10, but as you can see, I'm actually going to make $100. So my net loss is $15,000 out of my. I'm protected by losses I have. Versus if I bought this cheap thing, I'm only hedging less than half of it. So I'm only making about $4,000 back out of the $10,000 loss. And if the markets move even further, as you can see here, you're maintaining an almost dollar for dollar hedge with a more expensive hedge here. So if I lose $20,000 on the portfolio, I make $17,000 back on the expensive hedge and $13,000 back on the cheap hedge. And it's really only if the market really takes off where the expensive hedge will hurt your portfolio. So if the market moves significantly higher, Sorry, the market moves significantly higher. Here, I make $19,000 on my portfolio, but I give back $14,000 back on the expensive hedge, where I only give $5,000 back on the cheap hedge. So this is really the only scenario if the market really takes off where the more expensive hedge doesn't work out. But chances are, if the market does move that much further higher, you would probably cut your hedges before 2020. You'd probably get rid of this put if the market does rally significantly higher between now and expiration. So this is really how you can utilize our tool to compare buying a stock to buying a leap option. Some of the benefits of that is really being able to get that upside exposure with limited risk. But keep in mind that just because the leap options exist and just because those benefits are there does not mean that you should always trade a leap option. The best thing to do is really put the two side by side, compare them side by side, and see how they perform in different performance. You should, when you're buying a stock, you typically have some kind of price target. Plug in those price targets, see how they perform. Notice how in the Amazon example that I gave before, it didn't look particularly attractive because if the stock stays where it is, I'm losing quite a bit of money. Even if it moves significantly higher, I'm really making marginally more money than I do on buying the stock. So if I was looking at Amazon, I probably would not look at buying that leap option versus on the Apple example, it looked a little bit more attractive in my opinion. And then also if you're looking for a hedge, this is really one of the better ways to potentially utilize a hedge because hedging is expensive. And one of the best ways to minimize that cost of hedging is by buying a leap option because you minimize that theta decay. So make sure that you consider taking a look at these types of tools to help you determine exactly whether you should buy the stock or short the stock or buy a leap option instead. And make sure that if you're buying a leap option as an alternative to buying the stock, take a look at selling cover calls against it. The poor man cover calls is a very attractive way to generate yield, especially because it only costs you a fifth or a third of the amount of money to buy an outright stock. You're really going to increase your yield substantially by selling cover calls on a leap option versus cover calls on the stock position. So with that, what I'm going to do is I'm going to open this up for Q&A. Please, if you have any questions, please type them into the chat window. I see that there's quite a few questions already in here. I'm going to try to address them in the order that they came in. And I want to thank everyone for taking the time out this afternoon, and I'll answer as many questions as I have time for. Andy saying max risk is 25 times 100 is 2,500. Yeah, absolutely. So I put $25 just as illustrative purposes because I'm talking about per share. It's easier to see it that way, but absolutely, you're absolutely right. Your dollar risk is multiplied by 100 because each option contract is worth 100 shares. David's saying generally index leaps are more liquid than stock leaps. Yes, absolutely. Many index, well, that's not always the case. When you were talking about the major indices like NASDAQ 100 and SPX, absolutely. But if we're talking about like VIX leaps, those are not necessarily more liquid. Or if we're talking about Russell or some of the other ones, they may not be as liquid. So keep that in mind. Scott saying, would you lose $20 if you bought the $85 call for $20 if the stock went to $50? Yes. So you would only lose $20. Yes, I said there was a typo in the example that I gave in that spreadsheet here. Instead of losing $25 here, you would only lose $20, correct? Because you've only paid $20 for that. And there was a question about what about at the money instead of in the money, and I hope I addressed that in the two examples that I gave, or all three examples I gave. I compared buying an in the money versus an at the money leap. Like I said, in my opinion, the in the money leaps provide you with much better risk to reward because even if the stock doesn't go in the direction that you expect it to, because you're paying more, you're actually getting much more value for that. You're not paying all of your value in an extrinsic value. So the whole point of buying leap options is to minimize extrinsic value. And when you buy that at the money leap option, you're paying all of the extrinsic value. So you're not really negating that time decay factor. What delta do you aim for buying leaps? Like I said, we usually aim for 70 to 80 delta. However, another way to think about that is you want to pick a strike where the cost of that strike is roughly a quarter to a fifth of the underlying price. That's another way to look at it. In your put example, buying the 115 put for 25 would seem to offer a max value of 90. Minus 115, 25. Bob, I'm not sure what you're referring to. Happy to address that if you could just clarify that. David's asking, if holding a nice profit in common, would you ever recommend selling common, capture profit, and then buying corresponding leap to maintain exposure? Yeah, so I think the question is here, if you're long a stock and you've made profits on it, would you consider selling that stock at a profit, then buying a leap option to maintain exposure? I think that's exactly the type of time that you would consider buying a leap option, because you've taken profit on the stock. This helps you avoid a lot of downside exposure, because the higher the stock goes, the more downside exposure you have. And that's really one of the key points of using leap options, is to maintain upside exposure with limited downside. And like I said in the first slide, this is really why I wanted to address when to use leap options. You should use leap options when you have as a stock replacement strategy, but you see that there's some downside risks. And you're concerned that perhaps, even though you want to maintain that upside exposure, you're concerned that the stock may pull back substantially. This is especially true on some of the higher flying sectors like tech. Tech has been outperforming substantially, and I think there are substantial downside risks to tech. Also on the biotech space, especially biotechs, they've been doing really, really well. So you want to maintain that upside exposure, but these are also sectors that may pull back substantially if the market was to correct. So these are especially the type of stocks that you may consider using the leap for. Kamal saying that I have an error here on my slide, that at 120, the 110 call at is even. Oh, that's correct. This is not even. This is a $5 gain on a 110 on a 120 move. Instead of saying even, this is a $5 profit. That is correct. I apologize for that typo. Can IRA accounts sell covered calls against leap one's owns? Yes, because if you have an IRA account where you can buy a leap, then you can most certainly sell. Oh, actually, I take that back. It depends on your IRA account. If you have the ability to trade spreads, then you should be able to sell covered leaps. So it really depends on whether you have the ability to sell spreads or trade spreads in that account. If you can trade spreads, then you can sell covered leaps. Is there a benefit in buying debit leap spreads? No, I would never buy a debit leap spread, because you never want to sell a long dated option. You only want to sell short dated options. So the reason that you want to buy a long dated option is to minimize time decay. And the only reason that you would want to sell an option is to maximize time decay. And the only way to do that is by selling short dated options. So that's why if you're thinking about using leaps and you want to offset some of that cost and you want to offset that theta, you shouldn't sell a long dated option and turn it into a debit spread. You want to sell short dated calls and turn it into a poor man's cover call. Really, really good question, actually. But again, the reason that we're selling short dated calls against it, because we want to maximize theta. And the only way to do that is by selling short dated options. Since they are less liquid, do you look for higher open interest? Also, there are disadvantages of using deep in the money calls for leaps other than laying out. Also, are there disadvantages to using deep in the money leaps other than laying out more cash? So no, in my opinion, there's no disadvantages of using leap options that are deep in the money, other than they cost more. But again, like I was showing you, even though they cost more, they generally speaking perform better in most occasions. The only time they underperform is if there's a severe pullback. I mean, chances are, even if the market really starts to correct, you should have hit some kind of stop loss on the stock. Like I said, your decision to get out of a leap option should be based on targets that you have for the underlying stock. So that's really why I always encourage users to take a look at in the money call options, because if the stock doesn't really go in the favor that you're expecting to, and it just kind of stays where it is, you actually risk less money on the more expensive leap option than on the cheaper leap option. And to address your question about open interest, so open interest is not a good gauge of liquidity. And this is something that I try to talk about on every single webinar, because a lot of the deep in the money calls don't have a lot of volume or open interest, but that doesn't mean that it's any less liquid than an at the money or a short dated option. So you generally want to just pick the strike prices that suits you regardless of open interest, because open interest tends to pool around the round numbers. But that doesn't mean the round numbers are more liquid than the non-round numbers. It just means that there's less people trading those numbers. So keep in mind that open interest has nothing to do with liquidity. So don't use open interest in selecting your strikes. Pick the strikes that suits you based on delta, based on cost. That's much more. That's a better way to choose your strike prices. Is there a screener available to find attractive poor man options? I'm not sure what you mean by poor man options. If you're referring to the poor man's cover call, yes, that's exactly what our income tab is designed to do, is for you to type in any stock and be able to look at which cover call to sell against the leap options that you own. If that's what you mean, I hope that's what you meant. And if that's the case, make sure you use the income tab here and take a look at our cover call webinar that addresses this specifically. We really get into the depths of what to look for selling cover calls. Ben saying, as the stock price goes up, would you consider moving the leap to higher strike to recover some of the invested money? Not necessarily, because like I said, you would trade the leap the same way you would trade a stock. If you would take profit on the stock, then yes, I would take profit on the leap. If you wouldn't take profit on the stock, then no, I would not take profit on the leap either. Think of trading the leap as trading the stock. Is there a way to determine more liquid strikes? Like I said, the strikes, generally speaking, are not any. It's not like one strike is more liquid than another, because all strikes are, in theory, equally liquid, because liquidity is based on the liquidity of the underlying stock. It has nothing to do with the share. It has nothing to do with the strike price. So if Apple's liquid, then all Apple strikes are liquid. If Apple is not liquid, then all strikes are not liquid. So liquidity is a function of the stock liquidity, not a function of specific strikes or specific expirations. Would an in the money leap spread work best? Not sure what you mean by that, but I think, but what I'm trying to say is that if you're trying to spread in the money leap, the best way to do that is by selling short dated cover calls against that leap that you own. That is the best way to, or the most optimal way to trade a leap. I think one of your earlier examples, you showed buying a 115 put for 25 would give you a $100 max reward. Would it not be 90 minus? Oh, yes. I think it's possible that I made an error on this. I think the question was this one. If I bought the 115 put for $25, would the max reward not be 90? Yeah, you're correct. Because I'm paying $25 for it, break-even price on that is 90, so the max reward here is also 90. You're absolutely correct. I apologize for that mistake here. I will certainly correct these two mistakes on the next webinar. Why did you not mention selling puts at all? Because selling puts is a completely different strategy. Like I said, that's why I covered this first slide first before anything else. This webinar is only for a long stock replacement strategy and as a hedge for your portfolio. Neither one, selling puts isn't really necessarily a trade for any of these. So if you're thinking about selling puts, that's actually the webinar that I'm doing next week. So next week, we're going to be talking about generating income, the top 3 strategies for generating income using weekly options. That's when you want to sell puts. You want to sell puts on short dated options. You don't want to sell puts on long dated options because you have almost no theta. You're not going to generate any income from that. That's why we didn't talk about selling puts. Next week, however, we're going to be talking about selling puts. Rose is asking, in the case of buying leaps for a hedge, is there an equivalent cover call to offset the cost of buying the put leap? Absolutely. So the same way that you use the income tab here, we give you a cover call example here on the left, we give you a short put example here on the right. You can use this short put as your way to offset the cost of that long put. So yes, absolutely, you can use that. I will say, short puts, it's not as common of a strategy because you're in a hedge usually for a relatively shorter period of time than you are in a long call. So you usually may not be able to sell as many puts against it. So it's not as an attractive trade. Also, when you're buying a put, usually you're concerned about a big violent move to the downside. And by selling a put against it, you kind of offset some of that a little bit. So again, you can do it, but it's not as common because of those two things. You're not in that hedge usually for very long, which means that the offset that you have by selling puts against it is just not as strong. And usually when you're in a hedge, you're expecting a quick violent move or a quick fast move, and usually don't want to necessarily always sell puts when you're expecting a large fast move. So for those reasons, it's not as common, but you certainly can. David saying, don't you get better fills when a strike has higher open interest and volume compare a strike that has none? I haven't experienced that, David. If you have, and it's really difficult to say that because you can't really compare one versus another unless you have both filled at the same time. But I generally haven't found that higher open interest means better fills than lower open interest. Because again, if you think about how a market maker makes a market, to them, it doesn't matter whether you're buying the $1,800 strike or 1805 strike, which I'm guessing will have very, very different open interest, because for them, they still have to hedge the same stock that they have to sell you that call or a put. So from a market maker's perspective, they don't care which strike it is. If it doesn't mean any more liquidity on the 1800 strike versus the 1805 strike, where that has substantially less open interest than the 1800 strike. Like I said, it's just the round numbers that have the high open interest, not the odd numbers tend to have lower open interest, but really has nothing to do with liquidity. Can you say a few words about to stop loss a poor man's cover call? If you're referring to when to get, meaning if you're short that call, when to get out of that call, like I said, if you're in the early days of a leap, meaning if let's say you bought a two-year leap and you're in the first few months of it, and you sold a cover call against that leap, and the stock is above the strike price of the cover call that you sold, and that short call is about to expire, I generally find that if you're in the early days of your leap, you want to just simply roll that cover call, meaning you don't want to get it assigned. Because in order for that to be assigned, you have to then exercise the long call. And if you exercise a long call that's still 2 years from expiration, you're going to lose all that extrinsic value. And that's just free money you're giving up. So if you're in the early days, you just want to roll that cover call. If you're close to expiration, then maybe you could exercise the long call and to help pay for the funds to deliver the shares. Rolling a cover call simply means buying back the call that you've sold and selling another one. That's it. So if you sold this October 12th, 230 cover call on Apple, and on October 12th, Apple's above 230, to roll that cover call simply means you're buying back this call that you've sold. And let's say you sell now a November 240 call or 250 call. So just the concept of buying that call back and selling another one, that's what we call rolling a cover call. Would all brokers allow selling a call against a long leap? In my opinion, pretty much all brokers should be able to, especially if you have the ability to trade spreads, because I don't know of any major broker here in the US that doesn't allow you to trade time spreads, because this is really just a calendar or a diagonal. It's the same strategy. It's just that your long call is a long dated call. But so as long as your broker allows you to sell a calendar or diagonal, you can trade a poor man's cover call. The question was referring when the stock goes down significantly and the value of the leap goes down. Ben, the question was referring when the stock goes down and the value of the leap goes down. Yeah, so like I said, when we're talking about a stop loss for a leap, think of it as the same thing as stop loss on a stock. So forget the leap for a second. If you are bullish on Apple at 220 and you were going to buy the stock, at what point would you put a stop loss on the stock? So let's say if I was buying Apple, I would say that if the stock went below 190, I would probably get out of this trade. So you would apply that same stop loss to that leap, so that if Apple went below 190, you sell the leap. So like I said, when we're talking about leap options here for this purposes, it's almost the same thing as trading the stock. You're just replacing that stock with a leap option, but from a trading perspective, it remains the same. So if you're bullish on Apple, you think you're going to buy the stock, and instead you're going to buy a leap option and the stock goes down to 190 or lower, get out of that trade, get rid of that leap. Conversely, if the stock hits your target price, let's say you have a target price of 270 on Apple. When Apple hits 270, also that's a time to get out of the leap. That's what I mean by setting stop losses and take profits based on the underlying stock, not based on the option itself. Any other questions? I hope I was able to illuminate a new way to potentially trade stocks. Like I said, it's not for everyone and it's not for every specific scenario, but here are the tools that we present to you to allow you to really take a look at leap options as an alternative to buying the stock. And especially if you sell cover calls on stocks, selling a cover call on leaps is even more attractive way to potentially generate some income or generate some additional yield. Use the tool to really help you compare the strategies. There's no shortcut to that. You got to put the stock next to the long call, put in the scenarios where you think the stock's going to go, wherever you think the stock might hit, see how the stock performs, see how the leap performs, and that will help you determine whether you want to trade the stock or you want to trade the leap. And I just want to make sure that everyone understands that just because the leap option is there does not mean you should always trade it. You got to put the two side by side, look at the examples and see if they make sense for your given scenario, depending on how bullish you are. Like I showed you that Amazon example. In my opinion, I wouldn't trade that. It just, it's too much risk. Even if the stock goes higher, I'm not making enough return on that leap. So if I was bullish on Amazon, I'd probably just buy less shares of Amazon as opposed to buying a leap option. But on the Apple's scenario, I think that looks a lot more attractive. So put the two side by side. It really allows you to make that decision yourself. I noticed the score does not improve with long calls, say compared to a vertical. Yeah, absolutely. The long call is not going to be better than the vertical. However, the vertical does not allow you to take advantage of short. What the vertical doesn't account for is that you can bring in a lot of premium by selling short dated calls. So that's why it's not a fair comparison to compare a leap option to a debit leap, because you can't model the fact that you're going to sell calls against it for the next year and really bring down the cost of that leap option by another 20, 30%. If you had lowered the cost of buying that leap by another 20, 30%, you'll see that the options play score is much, much better. So that's why it's not necessarily a fair comparison. Richard's asking, is selling cover call a separate transaction from buying a leap? Yes, they are separate. Well, you can enter the first transaction together, but every subsequent call you sell against that leap is going to be a separate transaction. Any last questions? If not, like I said, this webinar is recorded. The recording will go out in about half an hour like usual. Next week, we're going to be talking about top 3 income strategies for selling weekly options. Very popular strategy. I know a lot of you sell cover calls, credit spreads. There was a question about short puts. We'll cover those 3 strategies next week. I will include the slides in the email recording that'll go out in about half an hour. And for those of you that attended our webinar last week on trading NASDAQ 100 index options, selling credit spreads, I want to report that we had great attendance there. I'm really happy everyone was able to get to that. We're actually going to do another one in 2 weeks with NASDAQ. We're going to be talking about how to hedge your portfolio using NDX. So please make sure that you look out for that email and register for that. It's a great webinar series that we're putting together talking about index options, not something that we really cover a lot in some of my presentations. So I'm really happy to bring index options into the education that we provide to you guys. Raymond, thank you so much. Michael, thank you. Richard, thank you so much. I really appreciate it. Thank you, everyone, for the kind words here. Yes, for those of you that are interested in the recording, the link for all the webinar recordings, like I said, it's in the email list that I send out. But let me see if I can send you the link here for those of you that want it here. So for those of you that are interested in the webinar recordings, I just sent a link in the chat window. There you can have access to all the previous recordings, but they are in the slides that we'll send out with the recordings. That will be going out to you in about half an hour. So again, thanks everyone for taking the time out. I hope you guys found this useful. I'll see you guys next week and have a great afternoon.